I'm Dom Meij, and I'm the Group CEO and Managing Director of Domino's Pizza Enterprises, so welcome. We're reflecting as we've now been listed for over 15 years, and I remember back to when we first acquired Domino's right back in 1993. And in fact, for those of you who don't know all of our history, we actually started here in Brisbane as a separate pizza company called Silvio's Pizza, and in 1993 we acquired the Domino's brand for Australia. And at that time, Domino's had actually gone broke 3 times in Australia. Like a lot of global businesses, as it travels, it doesn't always translate immediately until it gets a bit more of a global feel. And I remember that Domino's literally went broke each time because of Sydney. You know, a lot of big brands, when they travel, they look at a country as the city that most identifies that country. You know, if you went to the US, maybe New York would maybe identify the US as the most famous city. And Sydney was definitely that in Australia. And so for those that had tried to operate, most of the time they got very close to 30 stores and then blinked in Sydney because the losses were so big, because the brand was so unknown, and Sydney was a much bigger city than that. And our chairman, who's still our chairman today, our chairman when we were a private company, he had a very simple philosophy, and he said, you've got to think of each market as if you're in the real estate business, and that is, if Sydney is a 100-storey building, then you really don't get to pay your way until you're about 50 or 60 stores, or 50 or 60 floors. In other words, until you've sold those, you really don't have a building. And that's the same thing as a market, and it's been our philosophy ever since, is that you just had to break the back of getting to size and scale and getting distribution and building a brand and getting to that first layer of television. You know, one of the things that differentiates the brands from the independent businesses is often the ability to do mass advertising. And so they're the foundations that we've laid, and whilst in places like Australia, New Zealand and Japan, we can buy individual TV markets, those multi-storey buildings are much larger when you look at the geographies in Europe, where we actually have to buy the whole country when we buy television. So every market in the world, there was one thing that's common, and that is that proximity, or the location, really, really matters. You know, we termed a number of years ago now that time is the enemy of food, time to the customer. You know, the founder of Domino's used to say something really powerful about our business. He said, one of the things about the delivery business is, unlike the burgers and the fried chicken business, when your drive-throughs and your car parks are full, customers often will drive away. But in our business, when it originally was a telephone business and today is an online business, the customer has no idea how busy our store is when they're placing an order, and so it's almost exponential, and it can seem exponential on some of those crazy state of origins or grand final nights where, if it rains at the same time and there's all these other things that just peak every single element, it feels, if you're in a store, that it could be exponential. And then, equal to that is that many of our competitors never really appreciated what we learnt very, very early on in the delivery business, and that is that when somebody's hungry, time really, really matters. You know, if you're a large international firm and you're researching customers while they're sitting down having brownies and coffee and saying, well, what do you think? Is it 30 minutes? Is it 40 minutes? People probably don't value time as much as they're sitting in a different environment. But you get mum to place a phone call, and right there, every single minute matters. And so that's been a driving force for Domino's. We're coming up to our 60th anniversary as a business next year, as a brand, and it's what's been the clear differentiator, is that real appreciation for what happens to the quality of the ingredient from the moment it's cooked to that urgency for the customer. And it's sometimes interesting to us about the topics that flow across the Domino's brand, and sometimes that's just because we bring internal language to the external environment, and it sometimes gets confusing. If we were a burger business and we had 200 stores in Sydney and we thought we'd open another 30, most people wouldn't really challenge that. They're just putting another 30 stores. But because we talked about the word splits, or fortressing, it created a whole different mentality around it. And the reality is, to our customers, we create these imaginary lines which create the territories. Our franchisees get a 10-year territory, and we create these imaginary lines. And the customer doesn't really know the lines, although the way that they connect with us are defined by those lines. So you could be on one side of the street and go to another store, to the store that's on this side of the street, just based on the way that we've defined a territory through online, through telephone calls, with the phone companies and so on. But over time, those imaginary lines, whilst originally they were a territory where during a different cost structure, during a different positioning of the brand, those imaginary lines made sense. In other words, we thought we could at least service you, so we should put those lines in place when we open a new city. But as penetration grows, as territories change, natural pathways change, roads, infrastructure, even just shopping centres going in, people's view of where they'll go changes. And just because we put a line, it doesn't mean the customer perceives that we're a near pizza store to them. If you're here in Hamilton, this is the fastest growth part of Brisbane, and it didn't even really exist 10 years ago. And we have a really big volume store, which up the road, when we opened it, people went, wow, you're putting a store here, it's a bit early, and it's a really high volume store today. And yet this area used to be serviced by Clayfield, or actually, when I was a franchisee, this was served by Kedron, which is a very, very long way away from here. There is no way that the individual homes that were in this area 20 years ago actually thought that Domino's Kedron was a pizza store that would be servicing them. So we created those lines, and we were defining those lines, and over time, you can look at a market like Sydney, and when we listed the business, Sydney had 62 stores and was fully covered. We serviced technically every home in Sydney. Today we have 131 stores, and the sales have more than tripled in that market since the year after listing. So just gives you an idea, and we're still, Sydney's actually still one of the least penetrated of the major cities that we talk about in Australia. So there's still material more growth as we redefine those imaginary lines for our customers. So I'll share another story, having been in business 32 and a half years, is that when we listed the business, I had an envy for the rest of the Domino's world when I would go to a worldwide rally. As an Australian, and we'd rock up to Vegas or somewhere in the US to celebrate the global successes of Domino's, I'd sit there with my peers, and I used to have an envy that today there's 25 million, stomachs in Australia, and back then it could have been 17 million. And I'd be sitting across from peers with 50, 60, 100, 300 million, a billion consumers, and I used to have this real envy that, gee, I wish we had that, we had a lot of consumers, because there was always the fear when we listed that whilst we still saw a long runway of growth in Australia, and as it's turned out, Australia's continued to grow and will continue to grow as we've continued to build the brand. There was still this fear that we were trapped, and the second one was the Aussie dollar. 1 year we'd be parity, and that's how we were being measured against the USD, and then next, few years later we're at 50 cents, and we're seeing those roller coasters at the moment, and that's how we would be compared as we arrive in these markets. And so back in 2005, we were building a model for our future which said, should we be an Australian business that had other brands and remained in Australia, which is not uncommon for retailers, or are we really good at Domino's, and should we look at really being a Domino's franchisee around the world? And so we spread our wings, and first we went into New Zealand, and when we listed, in fact, we had entered New Zealand, but there was still a genuine comment at the time that we'd only been in Melbourne for a year, and we'd only been in New Zealand for 2 years, and shareholders would often say, well, really, are you just a Brisbane-based pizza company? I mean, you're not really making money out of Melbourne, you're not making any money out of New Zealand yet. So these were fair criticisms, because we hadn't really, although we had self-belief and we were building out our models, and all the same things that worked in all the other cities was working. And I remember sitting in a Melbourne cafe and someone going, well, why are you here? I mean, there's 800 pizza stores here in Melbourne. And I said, well, we only want 80. Well, there's not a reason for a chain to exist down here, and time has proven that there is. But that with our growth, we went into New Zealand. We then, within a few years, in fact, it's one of the fastest ways we've ever got to market leadership was in New Zealand. And then in 2006, we took the biggest risk, I suppose, that we could have made, and probably potentially the best ever investment that we made. We paid 8.7 million euros for the 3 countries of Belgium, the Netherlands, and France. As it turned out, we actually bought France and were given the Netherlands and Belgium for free. And the Benelux actually is the population of Australia and New Zealand. So to us, whilst it looks small to many other people around the world, we looked at it as a potentially exciting market. But we weren't naive, because actually the Dutch eat less out of, the only 2 countries that we currently operate where people eat less pizza than Australia is Japan and the Netherlands, and everywhere else people eat a lot more pizza typically than Australians. And we were so excited about France, and you're going to hear a lot from Andre today about France, and we're going to go back through some of the history and so on, because we like to remind people it is the second biggest pizza market on the planet per kilogram of consumption of pizza. So we always remind ourselves of that, and that was so exciting. As it's turned out, the Benelux has been the second most successful market to the ANZ business, and in fact, it has higher margins than Australia and New Zealand today. And we've actually taught the Dutch to eat Domino's, whether it's pizza or they think of it as a Domino's experience. But it's become a real success story and continues to have strong growth. We then entered Japan 5.5 years ago, and fair questions once again, a very, very different geography. But we've continued to apply the same model. And now that we've had time in these markets, I think you can see that whilst each market will have some different variables, and we'll often talk about those today, the big macro themes of the business are quite consistent. And then more recently, in the last 3.5 years in Germany. And I'm going to talk about the irony of the most recent two markets for our business. But even through that, the last 3.5 years, people like Andrew Rennie and myself spend a reasonable amount of time, and some of our global executive team, in that we're always thinking, what if Australia gets to the 1,200 stores in the next 5 years and therefore goes into much slower growth? What's the next engine rooms that are going to be coming on? How do you seed over a 3 to 5 year window? And you've seen that with Japan, and you're seeing that more recently with Germany and so on. Is that 3 to 5 years where you're building a market, and then if anything ever slows down anywhere else in the business, then that's now firing and kicking in, so that we can continue to deliver strong growth for our shareholders, for our people inside the business, and that even you can't underestimate the hunger of many of the executives in the business that want to have bigger roles, that have watched many of their people that have led them over time, and now they think they can do as good or better job and should be given that opportunity. So we were looking for other places to grow, and for 3.5 years we felt a little bit ring-fenced. Whilst in the Domino's network we weren't completely restricted, and we were given opportunities to grow within Domino's. We did think that they were a little more limited than our aspirations, and so we started looking at, for 3.5 years, we looked at all sorts of concepts and got very, very close on a number of deals. But the irony of all that is a lot of distraction for management and a lot of investment, traveling, doing due diligence, researching. When we would research our own shareholders, big risk. Well, you might be good at what you do, but once you get into another concept, are you going to be good at that concept? Especially if it's in other, double risk if it's in another geography where you're not even existing. So you might have bought a brand in another geography, and then you're going to take it back to your own geographies. Lots of risk, and so we were very aware of that. So being very, very careful. But the irony of all that is that something changed for us about 18 months ago, which really changed our focus as a business, and that is that. Domino's in our parent in the US had a new leadership, a new CEO, and sitting with the new president and being a little frustrated by the cost and distraction of looking for other future growth opportunities outside Domino's, and clearly knowing that the best value we could create for our investors would be to be more dedicated to Domino's. We sat with the new president and shared the three things as a franchisee that we would really love. Would be just so perfect if these three things existed. As any partnership, each side has their view, that they would present things that they would like to see from us. And we've always had a really strong relationship, as you would imagine, for the size and the performance of DPE. And we're very proudly Domino's. And in fact, in our own hearts, going to another brand felt a little bit like cheating often as a business, because most of us have dedicated our lives to building this business. But we sat down with the three things with the new leadership of Domino's and said, look, one of the things that we'd really love is greater access to more markets. And the team presented what that might look like, and I'm happy to say today that we now have the ability to pursue those markets. It's opportunistic, doesn't mean we'll be able to deliver them, but to know that we have the opportunity really opens our minds. And whilst we've only delivered two small ones recently of Luxembourg and Denmark, it does show that there's runway there, and there are bigger opportunities, be it that they're opportunistic, so we may never get to them, but we continue to now have the ability to go after them. The second one was shared technology. It seems strange to a lot of people, but because at Domino's we were leaders in technology, But we came at different paces and came at it in a slightly different way in the early days, that we actually built on different platforms around the world, different language. And so it wasn't synergistic for us to be able to get all our technology to talk. Whilst the platform inside our stores, called Pulse, which has been in our business here in Australia since around 2001 and is the global platform for Domino's, that is a shared technology in most of the world. Everything above the line, above our stores, was something that we all build individually around the world. And you think, we're building the apps and we're in the pizza business, we're building web pages, we're building unique technology that really operates a pizza store. And so we were a little frustrated and that we weren't sharing, and I can say to you today that just in the last 18 months, we took an inventory app from the US, which is a very smart app which improves our productivity and accuracy of stock taking in our stores, materially reduces the time. We received it from the US in Android. In a partnership, we gave it back to the US in iOS. More recently, we're now in a planned rollout of the loyalty program, which we've inherited from the US, where they've invested a significant amount of dollars and have a number of years now of really built-in experience in that platform. And we've now been able to leverage that platform. It's currently in rollout, as we talked about at our full year in the Netherlands, being tested in other markets. And we expect that will be in most of DPE within the next 2 years, and has been extraordinarily successful in North America. And those two things have been in partnership so successful that now the world's really opened up for us, and we're now working on technology that both where DPE is giving back to the system and we're going to take from the system, and the road looks more exciting than it ever has, that we're going to leverage size and scale throughout the Domino's world. So that's really exciting. And finally, the third one was just procurement, that we had borders and we had our own procurement teams and we didn't offer procure together. And I'm also proud to say today that we're now doing many global contracts. Whilst in their own percentage terms, they're not always material. When you're negotiating, there's a curve, and that last little element isn't necessarily always percentage-wise, massive. But if you can bring another $1 million to franchisees or $2 million into a country through better procurement by doing global contracts, then it's still worth chasing, and it's still margin on the table. So our big three tensions that we once had in Domino's are now, we couldn't be more happy. And that's really created a different psyche inside the business. Because part of this is that, well, you've got everything you've asked for, so it's all about execution. And that's how we've centered our team, is we've said, look, it's for us to execute against. Nobody's putting borders or boundaries or restricting us outside our own abilities and our own, a way to be able to excite customers so that we can acquire more and more customers as a business. And so, it's not lost on us today that, in fact, when you reflect on our business, and I go all the way back to those two envies, and I sit there and go, today, DPE services 9 countries, with Luxembourg about to open in October. Those 9 countries make up a bigger GDP than China, not that much smaller than the United States itself, and actually more population than the United States. And the US, already over 6,000 stores, on its way to a much more material number than that. And then, inside our business, someone would say, well, Americans eat more pizza, and we say, yeah, but we've taught Australians and Kiwis to eat a lot more pizza than Americans when it's Domino's pizza. We don't eat more pizza, but we eat more Domino's than Iceland's the only place in the world, little old Iceland, that people consume more Domino's pizza than Australians or Kiwis. So that's not our restriction. And so it really, really focused the business to say, all hands on, one brand, and really execute against this, because the growth potential in this business could go for the next couple of decades, just in the geographies that we have. And even just in Australia, we often, just because we're innovators and our mindset of thinking outside the box at other ways to grow the business, we were often doing some technologies and some other product menus that were very much not complementary to pizza, but individual meals that we thought we could take to the wider market. And that takes a lot of investment, a lot of research. I know one product that we worked on for 3.5 years, traveling the world, trying to get the best definition of it, trying to get the cost structure right. And the irony is, one of the reasons we couldn't get another brand as easily as we wanted is it's just so hard to get other concepts And there are some that exist, obviously, but very few that get the same return on investment that the Domino's business does all over the world when it's applied properly. And it's also the same thing about pizza. It's so hard with other food products to leverage those unless you're the specialist in those areas where you're single-minded as well and single-minded in the focus. And we said, the single-minded focus around pizza, the irony of pizza in Australia is that pizza is still too small in Australia. If you look at most of the other Western markets that we compete in, or if you reflect on the US, pizza's typically the second largest category. But in Australia, it's the third. Chicken is the second largest category in Australia, defined by particularly just really one brand that's done a much better job. As you could say, it's been the same case in burgers here. So, there is an opportunity, and Nick will take you through the math and the numbers, that, we can sell a lot more pizza in Australia. Be it that we are one brand, the dominance, when we've got a burger brand that's 5 times bigger than us and a chicken brand that's 2.5 times bigger than us, it's not that Australians by nature should have just eaten more chicken. It's just those brands did an exceptional job at executing. And so it's for us to execute. And you can see that with this mindset, how much we've been growing the share anyway. So then we took our leadership. We have 2 global meetings now a year with all of our global leadership and really centralising, saying, look, we're shutting down all these programs. We're investing all this money. We're putting all of that money into the things that are going to really drive the pizza success, really drive Domino's. Because, to continue to open our access with our partnership with DPZ in the US is that we also have to perform. Why would you give us anything if we weren't a strong performer? We only earn the right by delivering on what we already have at any one time. You get one more market. If you're not performing, why would you get another market? Why should you be allowed the right to do that? That's how we would talk to our sub-franchisees. You shouldn't operate any more stores than you can operate successfully. And so we talk about why do we exist, and we really wanted to look at our vision as a business, because our vision sometimes was confusing in the world of the aggregators, and we wanted to make sure that we were much more focused, that we could communicate to our shareholders, to our communities, to our team members, and defining our purpose. And we did define a new purpose as a business. And we first of all start with some of the macro environmental things around us, that we live in a world that's hardwired for human need for social connection, that human beings are social animals, have been for hundreds of thousands of years. Yet whilst we're in a place where technology connects us more than ever before, there's actually really a breaking down of that where people are saying, I feel actually a little bit even isolated from that, and I just have this yearning need that's just human to want to be with people. And also, that people, craving that belonging while they assert that right to be different. So, more than ever, once again, because of the internet and how, you just get so much diversity of being who you can be. But yet, as much as you want to be who you are, you want to be with groups of people. And we can see that, something about pizza. So this pizza can actually, just as a category, can fit nicely in this side of the curve, because pizza brings people together. And that's a universal thing. From Japan to France to New Zealand, pizza brings people together. We can show research after research, decade after decade, that it's the one thing that gets the teenagers out of their rooms to sit around the table to break bread and eat pizza. And look at the biggest things, our biggest sales periods are when there's the Bachelor finale, the State of Origins, Grand Finals, World Cups, Cricket 2020 matches. When there's an event, Melbourne Cup is the biggest lunch of the year in Australia, second to nothing, because it's when people are brought together. Pizza's the first thought. It's the first thought. It's also, Domino's was born in universities, and it's still the core of who we are as an attitude as a business, because university students like to get together. There's no cutlery. It's so easy to do that recycle box and put it in the bin. It's environmental. It's easy. It's affordable. It's a treat. It's everything about when you're 18 to 24. And so pizza really stands for that. But then when we're able to differentiate more uniquely at Domino's, and this is where we think, at our best, we really do smash the prevailing wisdom, which says you can't have quality, speed, and low price. Those 3 legs, most people would say, no, it's hard to be low price and quality, or how do you be fast and quality? They don't necessarily sync. Our rejectors of the brand believe that that's not possible. The rejectors of Domino's would say, no, because they're that quick, it can't be that good. Because it's that cheap, it can't be that good. And endlessly, we grow our market share because when people say, how did they do that? How did they get here that quick for that price, for that quality? And in fact, it creates community tensions. We have government bodies going, there's something not right about that business because it's just too unreal. But the reality is when it is that unreal, you grow huge market share because you create immense value for customers, and customers appreciate that. So when we're at our best, we deliver on those things. And therefore, when we're putting the world's most delicious and versatile bonding food within the reach of every person at Domino's, that's what we do. We democratize on an ongoing basis. We've become the biggest pizza brand in the Netherlands, the biggest fast food company in the Netherlands by store count in a place where they didn't even eat pizza because we created this value proposition, and it's Domino's that does those things. It brings Dutch families and Dutch environments and Dutch sporting environments together more than it has, in the last 15 years before we were there, because that we've been that player. So that's what brings us to our purpose as a business. Our pizza brings people closer, and that's what really excites our team. When you think of what you'll see in every touch point in every part of our brand, you'll start to see how much that communicates through who we are. We really feel that's our purpose, and that's what we're going to do in each of the countries. And at our AGM, we'll support this with our 5 new values, which are in some cases more from our previous values because they are who we are, but then they've been refreshed to really complement this. And so I look forward to talking about those in just a few weeks' time at our AGM. So here we are today. We're sitting here in October 2019, where it's ironic that we've gone full circle after a little bit of distraction in some of that time. We're one brand, one core focus as a business, and one purpose and we're rolling this through our network. And you'll also see some amazing communication that's going to come out about that for our people, which we'll share with the public. So it's so funny, 2004, we listed the business. This came straight out of our prospectus, that the growth of home pizza market will continue as a result of longer working days. We've seen that around the world. An increase in dual career households supporting demand for freshly cooked delivered food. And delivery, we're in 2019. In the next 7 years, nothing is more disruptive in the QSR than digital delivery. And we're going to talk a lot about that because because it's so disruptive, it confuses people because it's so new and it's so challenging and of the paradigm that whilst food consumption around the world in our markets is typically growing about 1%, delivered food inside that, people shifting from restaurants and drive-thrus and takeaway and moving to digital delivery, growing at huge numbers of 25 and 50 and 80%, compounding numbers. We've already seen in the last 3 months, I've been to 3 different places in the world where digital delivered food, China are now at 24%, Korea at 22% of all food takeaway consumed, Dubai 60%. Well, it's 45 to 50 degrees outside, so it kind of makes sense maybe, but that's just defining what's happening everywhere around the world. And so we're now, what we were born to do, is that rather than have in the past with a headwind of competing against drive-thrus and so on, it's now a tailwind to our business because, we're good at this. And the model that defines us more than anything that's a core focus in our business is what we call Project 310. And as a data-driven business now of getting so much information from what we do and how we perform, is that obsessed with this whole philosophy that's been in the DNA of Domino's from its birth, that time is the enemy of food. Project 310 is the ultimate goal to have a carry-out in 3 minutes on average and a delivery safely delivered in under 10 minutes throughout our network. And as I mentioned earlier, we've got so much data. We can track millions and millions and millions of orders all over the world. And every time we get down per minute, we can watch frequency grow, we can watch ticket average grow. And now we're in new territory because we used to think of the ultimate holy grail was 18 minutes. There's this magic point that we had enough data that was 18 minutes. But now we're getting down into places where, wow, what's happening when you're at 10? What happens when you're at 5? What actually happens to consumption? How does it shift the paradigms in our business? And we're still learning about that every day. It probably shouldn't be surprising, but it's just what is now happening at this deep new epicenter that we're now creating in our business. And we're proving that we can consistently do this around the world. The Dutch set a world record last July at 3 minutes and 36, and Japan went and beat that. The irony was Japan a week before 2:38 did a week at 2:37. which was a little bit heartbreaking for them. Sorry, 337. 337. So we just missed the Dutch record, and now hold the Domino's global record for 1 week of averaging 2 minutes and 38 seconds. Think when you press enter in the app, when you hang up the phone call, and the driver's at your door. It's extraordinary skills. And here in Australia, you know, the Ferny Grove store just not too long ago. In fact, I'm hosting the Ferny Grove team at my house tonight as we're celebrating. It's a little bit of a shame that I didn't then invite the Eastern Hill guys, because they then quickly knocked that off because they held the record just before that. And so that will be a different dinner party for those team members to celebrate what they're doing. And, you know, now for a whole month, the Eastern Hill store averaging 7 minutes 20. Now, this is happening all over the world, but it's typically happening in individual stores or clusters of stores, and you'll see some of the data that the gentleman will share with you today, because it still does require really good management and really good execution to deliver these times. It does require above normal that we could expect 52 weeks of the year performance. It does require that. We have the knowledge, we know how to do it, but it requires extraordinary behaviour, which isn't replicable all day, every day. And so what we do is that we're systemizing that. And some of these names are removed, but they're genuinely real projects, and we removed the money because as shareholders, that's the DNA that you're invested in, that these are things we don't want to share with competitors today. They're technologies that we're investing in, that may even be in test in stores. But through these record-breaking, we do human experiences. We say, well, can we turn that into an automated process? Because if we could automate that process, so it happened 365 days a year, every single time, because it was an automated process, then it just happens. And it's you know, in Australia today, 1 minute is 50 cents of labour, 1 minute. Now globally, a Domino's store makes somewhere between $1.50 US and $3 US an order. I'm using Aussie cents for 50, so convert it how you want. But it's really material. And when you start saving these minutes, it's material to profit. You know, our franchisees get to keep some, we pass some on to the customer, and some on to our shareholders as we continue to get more and more efficient. Inefficiency is passed on to the customer. Efficiency is being able to be passed back to the customer through benefits of better quality, better service, and so on. And some of these technologies have an incredible payback because of that. You know, often when we would sit there with our board, or in the early days of building technology, or even explain to a shareholder, if I'm investing in this new technology which doesn't really exist right now, what's its ROI? The first time we did an app, what's its ROI? Well, we were only the second app to be registered in the App Store in the world for pizza. What was going to be the ROI? This stuff is very measurable because it's operational, executional. And this is where we can compete and build proprietary technology for our franchisees so that they can be more competitive. Our team members can be more competitive, more efficient, and then can offer just extraordinary value where people say, how did they do that? And this is our model. So over the next 1 to 3 years, these projects, and ironically, the Eaton's Hill has just taught us another project which is going to fit up there. So as we continue to push, I'm sure we're just going to continue to learn, and then our job is to systemize it so that if you invest in a Domino's franchise, if you invest in a Domino's 4 walls, that you get this technology. This is stuff that defines us and differentiates us. And in many cases, it's not stuff that is easily replicable. The only thing in our stores around the world typically that we don't manufacture, build to everything that we do is Coke or Pepsi. Everything else is designed. So we're from every element of our delivery bikes to the technology, to our stores, our maps, the whole way we build our products and brand is all built for this. And so we couldn't be more excited. So more and more, we want to make sure that our investors are aware of the leadership that we have around the world. You can't do this without incredible leadership. I'm really fortunate today to have Andre ten Wolde, COO from Europe here to talk about Europe specifically. Nick Knight, many of you know, the Australian New Zealand CEO, and Josh Kilimnik, who's our Japan CEO. And we're very fortunate in the Domino's world. These people are well sought after all the time to go and do speaking to other markets around the world because they themselves are quite well known throughout the business. So I'm going to now hand over to Andre to talk about Europe. Thank you very much.
For you who don't know me, my name is Andre ten Wolde. I've been in the Domino's business for 15 years. The first year of that was I worked for DPZ for the Netherlands and Belgium. So I was present when DPE took over the market, and actually never looked back after. thank you all for showing up. I feel fortunate to talk to you because whenever I'm in investor meetings or during our presentation of our results, I feel the focus is a lot on ANZ, and I don't get that because Europe is 55% of the mouths we can feed within the DPE system, and also I feel that things that are possibly new in Australia are not as new for us in Europe. So I feel very fortunate that I get the time to talk to you guys about that. I do talk about Europe a lot, but actually Europe is a economic community. Well, in some sense, some people want to leave that community again. But all the countries in Europe, they're really, really different. And even regions in those countries. The south of France is incomparable with the north. So it's not the United States of Europe. They're vastly different. And that makes it a little bit harder to explain what's going on in Europe sometimes. I mean, Netherlands is easy market. It's only 18 million people. It's easy to manage. Where France is this big elephant with lots of people in there. Germany is even bigger as far as people in there, but it's a smaller landmass. And for me, I've been fortunate to do the Benelux for a long time. And that is just an easier market because it's so condensed and it is not a lot of people, but France is really difficult in the sense that the market is that big. So just quickly about Europe, the landmass is about 59% of the size of Queensland, and that's where we have our 185 million people living, so quite condensed. And we still have a lot of mouths to feed per store, but we don't reach them all. I mean, France reaches about 31% of the people with their current store mass of the entire France. I think Germany is even less than that. So we're still very underdeveloped in some of the markets. You know all these numbers. We're getting close to 3 stores per franchisee now in the market. And that's been diluted a bit by the takeover of Joey's and Hallo, which were generally single franchisees. We're changing that model, and this is the Europe number, obviously. It's a really funny site, that truesize.com. I thought we would fit into Australia. I didn't know we fit into Queensland. And there's a lot of, and the markets are really, really different. I get questions from the likes of you guys and said, "Oh, France, they eat snails and baguettes, but they don't eat pizza." And like Don said, they are per head after the US the second biggest market in. If you look at the weight of the pizzas, they eat a lot of pizza. 90% of them eat pizza. So yes, they probably eat snails, but I'm happy not to be in the snails business because that's a really low volume business. The pizza one is pretty good, but they also have a different history than Australia, and we tend to forget about that. I mean, obviously pizza origin is Italy, but it was considered to be a poor man's food for a long time in Italy, and it wasn't that popular at first. Different from France, the people that started working out of Italy and went into France. They sold pizza as the first quick service that you could. There's a lot of those really funny trucks around. I think a large part of the pizza market is still those pizza trucks. There are a lot of them around. It's pretty good quality too. So even before it became big in Italy and before it became big in Australia, pizza was already a big deal in France. So also, that worked into a totally different market. 50% of the market, or even more than 50% if you take all the local mom and pop stores and the trucks together with the kiosks and vending machines. Yes, they do exist. Really small towns, 200 houses, they all have a vending machine in there. And then once a week, the truck rocks up at the local market. And if you look at 100,000 places where you can, so every 800 people in France have the ability to buy pizza somewhere. And look where we are in this 4% part. And we're clearly the market leader by far in that 4% market, but it is in that 4% market. Where do we need to get our share from? We need to get it from here. And we will, and we are. But totally different from the Netherlands, for instance, or Australia, on how the business was built. Look at the Netherlands. Don already mentioned it. Also in the Netherlands, pizza is the third biggest category in QSR, where it's the first in France. But still, we managed to have the most stores in the QSR market. Some really interesting names there. That you probably don't know, but you know McDonald's and Subway and Burger King. Our biggest competitor is a local guy who's only in the Netherlands called New York. Also has a decent amount of stores. So in that sense, we're actually doing worse than France, because France, from chain pizza, has a way bigger share than we do, because they actually made the other chains look really bad. So Netherlands looks totally different from France, but still, I mean, we might be 34% in the pizza market, but it's also only 5% in the total QSR market. We need to expand the QSR market, which is mostly dominated by, well, almost 50% is Asian, which is a big grower too, and obviously the Dutch have a history on occupying some countries in Asia, like Indonesia, and that's where we get all our great food from. And but it's grown a lot because it used to be fries, burgers and fries used to be the number one, but because of Thai food and sushi, this part grew a lot. But we've grown this category, and this is the category we're in. Obviously, this is not us, but this is the category, the pizza category we're in. That has grown relatively and in absolute numbers a lot over the last a couple of years, and I think we had a big part of that. So, Don already mentioned this. It would be easier to eat an elephant one bite at a time, right? But all the markets in Europe have national TV spend, and TV is still pretty important for us. And we talk about TV. We talk about, we're going to be on TV in Germany. So yeah, we are. We've been on TV for the last 3 weeks. But that means that we're on TV 2 days out of those weeks with really low tariffs, because that's all we can afford. And we're still communicating to like 75% of customers that can't even buy Domino's. So it's really effective for the stores, because TV brings a lot of additional sales. But if you look at the money you have to put in, it's still very ineffective. Netherlands is the only market in Europe where I would say TV spend is close to optimal. We do a lot of really strong media mix modeling, so we look where we can spend that €1 best. We do a very interesting study in the Netherlands that every time we're on TV, we're looking at app usage and website usage, so we measure exact the time we were on TV then and how do customers respond. So we're quite smart about that. Josh told me in France, or in Japan, that you can't even buy the day of the week, let alone the time of that day that you want to be on TV, where we're a bit more sophisticated, fortunately. Germany just started. France, we are on TV. We'll tell our investors we are on TV, but if you look at the presence of us on TV, it's just a couple of days a week, and it's maybe half of the weeks a year. That's all we can afford now. So with growth, the good thing is that we can afford more TV, more marketing, be more visible on all the digital media, which does deliver growth. But we're really frugal and looking what's the best media spend that we can do. How is this euro best spent? And then sometimes TV just falls off. Okay, so little game on Europe. We're obviously under-penetrated, even in the Netherlands. But what if whole of Europe was as penetrated as the Netherlands? It will mean we should have 2,372 stores. We feel that's very achievable, and also on a not too distant term. But let's look at something that's also in Europe. What if we had the same penetration as the UK? We'd already look at 3,274 stores. And also the UK eats a lot of pizza, but not as much as the French, we just learned. Taking it a step further, obviously ANZ is the most sophisticated, large market with the highest penetration within Domino's. If we had the same penetration as the ANZ, we should be at 5,000 plus stores. So you can imagine every meeting I have with Don, he tells me, what the fuck are you doing? You should do more stores. But there's Don already talked about Iceland. There's also Iceland. That's a European market. It's a different market, I can tell you. And I don't think we're going to achieve that. And just a reminder, our official future outlook, anywhere between 2025 and 2030 is 2,850 stores. So somewhere in the middle of here. And for the UK, you could almost read US. I think US is about 55,000 households or customers per store now, and they're still building a lot of additional stores. So to me, obviously, this is very exciting. I wish I was here already, but we're getting there. Two things I get confronted with if I have meetings with investors is this fortressing thing, and what does it mean? Don already said our internal lingo used to be splits, but we call it fortressing now because I think it's widely misunderstood what we're doing. I think that people look at it as we're taking away possibilities, and we've all learned when we went to university or school or whatever that the bigger the market, the better, which sounds fair, right? You want a market that is big as possible. But actually, in our business, a customer doesn't think that way. They think we need this value pizza driven to us with great quality as soon as possible, and especially that soon as possible, that delivery part that we have. We're not retail in the sense that we can wait a day for the wash machine or dry washer or whatever it's called. That takes too much time. We need to be the fast. So fortressing, I wish we had no term for it. It's just building the market. It's just making sure that economically and from a customer perspective, we're as close to the customer as we can. So I wish I could talk about Berlin, about fortressing, or some big city in France, but I can't. We haven't even. If you're only delivering to 30% of the customers, we haven't even started anything that looks like fortressing. This is Berlin. Berlin is, I think it's 60% bigger than Brisbane, or almost double, and we only have 32 stores there. And we deliver. I'm not sure if you can see this. We deliver these areas way too big, and actually. These are their legal delivery areas, so not their exclusive areas. But most stores don't deliver it to those areas because they're just too big. So all I can talk about is the Netherlands because that's where we started something of fortressing. We're still not there, and I can tell you that all the things that are true for Australia, and Nick will talk to that a little bit more, are true for the Netherlands as well. If we take a piece out of an area, it doesn't need to be 50%. This is not 50. On average, we take 28% of an area because we're still small in fortressing. We see an immediate lower runtime, so it means we're at the door for the customer a lot quicker. You can say, okay, what does that mean? Well, internally, that means that we have less labor. And labor is getting, even in the Netherlands, which I consider in our markets to be a low labor market, even in the Netherlands, labor is getting more expensive. And it also gets harder to get actually people delivering for you. So this is important. But what's way more important is that customer rate that. So the sooner we're at the door, so this is going up almost in time, the higher our ratings through NPS are. You can say a lot about NPS, but it's still an indication of what people think. And that doesn't mean anything either. But this is important, because the higher your NPS score, the higher your same-store sales growth. And that's what you want. You want to grow faster than the rest of the stores that are not delivering at the same speed. So speed of delivery turns into more sales. And obviously there's a optimum in there. We want to be at 310. We think that the optimum is there. And we know, we do a lot of research, we do a lot of deliveries, and we can do, with all the data points, we have lots of analysis, and we know that's where it is. And we also know, or think, that we are the only one who's capable of doing that. The thinking of having that, the bigger my market is, the better I do, it comes from that stores with a lot of, these are households, do more orders. The thing is that the difference between half of those households is that most of the additional orders are actually not profit orders, or not as much profit, because you have to drive longer. You have to do a lot of marketing to that area as well. And people get a less result, not as good as pizza. If you look at it different and go, but how much actually do we make per household? And these are Dutch numbers, these are euros, and you will think, ooh, that's very low. That is correct. We are still at a very low number per household. But Dutch don't eat a lot of pizza. That's what we need to change over there, and that's what we are changing. But it is more than double the amount per household that you get if you have lots of them and not servicing a big part of your customer base as good as you could. So this is where the big mistake comes from. Yeah, I need a bigger market so I have more orders. Long term, you won't, because lots of your customers will have a bad experience. Good. So we've proven fortressing in the market mainly through our corporate systems. This is an area called Groningen. It's a student city. It's where we did the record week in the north of the Netherlands. And in quarter one 2010, we had one store there doing about 100,000 euros a quarter. I remember the franchisee. He's currently our CEO in Germany. I'm not sure why we did that, because he didn't do a very good job there. But in all fairness, he just took over. It was not a brand. And this is where we started. Currently, we're at 8 stores. We're building 2 more in that same market. Obviously, the market has grown. It's now about 500,000 people living in the city of Groningen. But you can see how incremental the sales have been. Obviously, we've been more successful in that period. Our name recognition is a lot higher than it used to be when we were there. But that's logical, because we have more locations. And also, we need to have that to be able to build more locations. And just to show it's not a one-off, this is Leiden, another student city in the middle of the Netherlands. Same deal. I could have shown you a graph of our competitor, which I can't do because that's not public information, but we sort of know what our competitors are doing. And you'll see a really flat line, or even a declining line. So that's for me about fortressing. The other thing that I hear a lot about aggregators, and they're bad, they're stealing sales, and I can understand, because aggregators are considered to be new. They're not, especially not for Germany and the Netherlands. They've been on aggregators since 1999. And those started as the order aggregator, right? Not the delivery aggregator. They came later. They are relatively new. But the order aggregators have been there, and with various success. But in the Netherlands and Germany and in Denmark, where Just Eat started, in the Netherlands, Takeaway.com started just around the same time. They've been really, really successful. Some of you might invest in Takeaway.com or other aggregators. And when I started at Domino's in 2005, 100% of our digital sales, 100% of our digital sales came through aggregators. That was Thuisbezorgd.com, that is the Dutch brand of Takeaway.com. And that's all we had. There was you could go to a Domino's.nl site, which was actually a skinned version of the aggregator site. That's how much got invested in digital back then. And luckily enough, when DPE bought us, we got One Digital, our digital platform within DPE. And we managed to change the percentage of digital sales into roughly 80-20. So 80% of our traffic goes through Domino's.nl, our own digital platform, and we still get a little bit under 20%, 18% through the same aggregator. You can imagine that this 18% here is way more than the 100% was back then. I mean, you see that our delivery sales through, this is the delivery sales through Domino's.nl, this is the delivery sales through the aggregator. Both of them are growing, but in percentage, this is lower now than it used to be there. And these are the offline sales who are flat and almost a bit negative. So they complement each other. You get a different experience through aggregators than you do through Domino's.nl. I believe you get a better experience through Domino's.nl. You can imagine that. But they are complementary to each other. And I don't look at them as a threat in that sense. Obviously, they want some money out of the market that we're in. But I don't look at them as threat. I look at them as digital fortressing, and now I like the word fortressing all of a sudden, because we use them as a search engine. We use them as a marketing portal to get customers in. And I just like customers, and I don't care how a customer decides to order with us. If we still had fax machines in the stores and people would order through fax, I would be fine with that. I just want more customers. And we use them as an advertising channel, and this slide tells you a lot about that. So these are all sorts of, this is a digital order share by source. You can imagine that Google's in here. Google wasn't in there when I started, or hardly in there when I started. Google was just another advertising channel. And here's the paid Google stuff that we do, and you see the returns on investment. You also read the returns on investment through aggregators of getting an order through an aggregator. So that is what it is. It is a digital advertising channel. And you see that some of our markets have a high, relatively high aggregated percentage, but also markets that are growing pretty fast, both in our own digital platform and through aggregators. So it's not that aggregators are stealing from us, they're helping us to grow. Mind you, over the years, and Don can vouch for this, we had lots of debates about aggregators. And we've tested a lot. We've just shut stores off in the Netherlands. We've opened stores without aggregators, and we tested a lot. But we just found that they bring you new customers, and some of the customers will actually go, oh, I tried the aggregator, and I tried Domino's. Oh, I like Domino's better because it gives me more functionality. It gives me the opportunity to do half pizza or build my pizza from scratch. It gives me discounts, which we don't do through aggregators. We just give you a fair menu price, same menu price, but no discounts. Gives you the opportunity for bundles. So there's different functionality in our website and our apps to aggregators. But there's the odd. I have someone who calls himself my friend, and I'm not sure if I call him the same, because he just said. Convenience for me is having one app, and I order my food through that app. And I hate him for it because he has to download, obviously, the Domino's app. But he says, that to me is convenience. I'm not really looking for coupons or deals. This is for me convenience. When I open the app, I don't even know what I'm going to order tonight. So that to me is the best experience. I'm okay with that, as long as he sometimes, or lots of times, clicks on the Domino's menu and orders from us. So we do look at aggregators a little bit different, right? The new aggregators, they're not new anymore, are also delivering for you. We don't do that. We don't think that that's the way to go. We fully agree with our US mother, or that's not the right way to go. And we see a lot of things happening in our markets that we're really happy that we're not delivering through them, because, and you read the news, the people are not rewarded as the way they should. There's subcontractors, believe it or not. We see a lot of people rocking up that are not the same as we thought they would be, and they don't speak the language, and they deliver your food. We are really focused on safety and having a single brand. So for us, it's really important that we deliver ourselves. We also think that it's normal, and especially in the more socialistic countries where we are. Donald keeps saying that Australia has become a socialist country too, but that we pay our taxes. We just pay our normal share in taxes, and we don't always see that happening with other aggregators. And we want the control over that. So, are they profitable? Yes, they are. They're very profitable. So, what's the big difference? The big difference is ticket. Believe it or not, we give discounts on Domino's sites, and we don't do discounts on aggregators, but our ticket is way higher. Why is that? We're very smart at upsell. We're just a little bit more sophisticated to our own customer. We give them the opportunity to add ingredients. So our ticket is higher for a Domino's order. And our food's lower because but our food's lower on aggregators because we don't discount there as a percentage. But we do charge in aggregators a delivery surcharge to a customer, which flows right back to us. And with that, and most of the time that's way more than we pay the fee to the aggregator. So an aggregator order is very profitable for a store. Maybe not an absolute number because the ticket's lower, but definitely in percentages. You don't bank percentages, I know that. But in that sense, I like an aggregator order just as much as a Domino's order. Does it make sense? We can have questions later, right? I'm done. I'm handing over to my good friend Nick Knight.
Good morning, everybody. So I just want to start by reiterating our long-term store target in Australia and New Zealand of 1,200 stores by 2028. And I want to walk you through some of the numbers behind how we get to that and why we still really believe in that as a target and being entirely achievable for us. You've heard a lot of different data today around size of markets and penetration models, and it is true that aside from Iceland, Australia and New Zealand is the most penetrated major Domino's market in the world. But whilst that is the case in pizza, the big opportunity for us is to look outside of the category. And you've seen numbers already earlier this morning that show the size of the pizza category in other markets around the world. And what you'll notice is that it's quite small here in Australia in its entirety. And whilst we've been able to continue to grow the category through taking share from other parts of it, through burgers, chicken, sandwiches, potentially retail, that spend, we now command a 3.6% spend of the QSR market. It's worth noting that that number was 2.8 just a few years ago. So whilst we are growing the pizza category, we're growing that through taking share outside of it. And you know, when you look at the burger businesses and the chicken businesses that are here in Australia and compare those to other markets in the world, it's entirely possible that we can sell a lot more pizza and do a really good job of that here in Australia. So let's take a look at, well, what does an Australian store penetration look like compared to, say, a US store? And when you look at the number of population per store, you can see that straight away our friends in the US have far less penetration than we do here in Australia and New Zealand. We're at 35,000 already per store. So, you know, that would maybe beg the question, is that as far as you can go? But I think if you put it in the context of looking, well, what does the top 4 players inside the category look like in terms of a penetration number? And then you'll see a very different number. You'll see that here in Australia, the top 4 players have a penetration of just over 20,000, whereas in the US, the top 4 players have a penetration of 15,000. So pizza is far more penetrated. I want to recap now and show what we shared at the last Investor Day, what happens to a store when we fortress. So this is based on nearly 100 stores that were split in that time frame of 5 years. And what you'll see there is not only does the original store return to its original sales, we more than double the sales from that territory. The big point to make here is, though, we're not doubling, just the extra dollar doesn't replace an outgoing dollar. What it does do in that existing store is it creates huge efficiencies. Those efficiencies are additional sales, so that enables us to get more leverage, buy better, scale. Operationally, costs reduce, and I'm going to talk a little bit more about that, but I think the main point to keep recognising is that we're not in just a retail business that's transacting at the shop front. A lot of our sales come from delivery, and the cost of delivery is variable depending on the time and the method that you use to execute it. So when you get sales coming closer to your home store, you're getting an immense amount of leverage in what is your biggest cost. And whilst it's variable, it's almost a fixed cost when you go to execute that delivery. You get higher brand consideration. More stores means more people think of you, and you get much better return on your marketing dollars, because the number one reason someone's likely to frequent your business is because it's their local, they consider it to be their local store. So that investment in marketing has more resonance with the consumer. So let's look at a store as an example. So this, again, still a recap from what I shared last year, but I think people were really interested in how this breaks down and then builds up. So if you can see here the original delivery sales from that store. And even after the Fortress, you don't see a material decline, and you see over time, through execution, those sales are replaced with other sales that are more profitable and closer to that territory. Again, through adding that store and being able to market that territory, you build in a new layer of delivery. So your delivery business is very healthy. You get to grow a huge amount of sales from your existing territory, and those sales are far more efficient at a store level. So then what happens is you get a lot more pickup sales straight away. It's incremental. Those customers that are coming to you didn't consider the existing home store to be their local store, and if they did, it was too far of a trip to frequent often. And finally, the new pickup sales come in, and you can see that you don't lose any pickup sales throughout that process. So this is still a recap, but I think it's important to share what it looks like when we, in real terms, fortress a market. Don already shared this morning that the lines, they're arbitrary lines that we draw up, in many, many years gone by, of what we think is an achievable or a deliverable territory. And you can see a real example here. That's the original territory for that store, doing about $45,000 in a week in unit sales, very profitable store. Why would it make sense to then add another store into that territory? Well, the reality is that new store is a long way from the home store, and it's not likely those customers were getting a great experience at all. They were getting access to us potentially, but it was more likely cold and late, and would have had to have been more expensive for that store to have made any money from accessing those customers. And you can see here, it was likely that was largely rural or farmland when that original territory was signed, and there's potentially a third store now as that part of the world grows that will be very possible and achievable in the coming years. It also enables much more efficient methods of delivery. When you are closer to the customer, you can enable things like electric bikes, which have a far, far better return than a petrol car, for example. So it's definitely true for a store. Is it true for every store? Well, this is the average of 69 Fortress territories in the last few years. And you can see here straight away, as I mentioned before, the pickup sales are incremental, almost straight away. And then through execution, you build more profitable delivery sales through more frequent customers that are closer to the store. So then if we extrapolate that out to a market, you can see with this example here, over a 6-year period, you've got an 86% increase in sales through fortressing. You've got that equates to a CAGR of over 10%. And not only have we got nearly double the sales, those dollars from an economic point of view are have far more leverage in them at the store level and allow the franchisee or our corporate store to make a lot more money. And then finally, if we build that out to what it looks like at a country level, you can see that the existing store sales continue to grow and the new store sales are largely incremental. And I think it's worth noting that, that incremental growth from new stores in the last financial year is probably the equivalent of our largest pizza competitor in this market. So it's not an insignificant amount of sales. So is 28,000 people per store possible? Can we get it there? And it's nice to look at some of these examples of how we got to where we currently are, but how do we get to where we want to go? Well, the good news is we've already got there. And the reason for that is our penetration target is already well overachieved in a market like Queensland. So a very big market for us, and we also have stores we want to continue to open here, a lot of stores in Queensland, so we can penetrate even further in Queensland. So the point I'm trying to make is that we don't need every market in Australia to get to the level of penetration that we're guiding to. We're already well beyond that in a number of markets, and we'll continue to go beyond that even further. So this to me shows really clearly how we are able to execute at that level of penetration, and we can sell a lot more pizza. I want to talk now a lot about our Operations 360 program and how that's helping us change the ability of execution inside our system. And the one thing that's never been clearer to me, never been truer than it is today, is that the business still, number one driver of success is the operator of that store. Beyond any other metric, beyond the area of where that store is located, the demographic, the quality of the leasehold, it far pales into significance compared to the quality and calibre of the operator. And we are really pushing hard to help our franchisees get to the level where they can execute at their best. Some people, however, don't have the ability to do this or the passion, or they may have lost that passion, and we identify that through our Operations 360 program, through grading franchisees and benchmarking their stores and allowing them to see where opportunities exist. So I want to talk through a little bit of how that cycle looks when, in some cases, we bring that store back in as a corporate store. I like to think about it as we run a bit of an orphanage in that sense, and then we invest back in those businesses, and they ultimately become franchise stores again in many cases. So the first part of the process is identifying that store operator no longer has the passion or desire to achieve the level of operations we require from them. First, of course, is putting them through some really detailed and intense training and really doing everything we can to share with them how they might lift the level of their execution. But if that's not an option, then in many cases there's a repurchase of the store. Well, in most cases there's a repurchase of the store, and sometimes becomes a corporate store. So from that point, there's an investment made by the new owner, and that is in hiring and training new teams through marketing and reinvestment activities, and lifting the level of the operation base of that store. From there, in most cases, there's some capital expenditure in equipment and a refurb. And you can see an example there. A store goes from looking tired and old in that bottom left-hand corner to new and fresh and modern in that top picture there. From there, stores are typically refranchised and sold out to neighbouring franchisees or managers becoming franchisees for the very first time. And that's one of the things that I'm really proud about in this business, is that we do create those opportunities for our teams to become successful business owners, and in many cases, multi-business owners. In that process, there's obviously a lot of investment, but in most cases, that's more than recovered by being able to then sell that store as a going concern that's trading profitable sales with new and updated equipment. From there, the benefits of having a higher quality operator are very obvious, and I'll talk through a couple of examples of that in a second. And finally, that then flows through to DPE through higher increased sales, better leverage for our franchisees in marketing funds, and a better experience for our customers. So I'll share with you two examples today, and I think it's important to note that these aren't examples where we've even replaced the outgoing franchisee with or the top tier calibre of operator. We've replaced them in these cases with a B franchisee, which is doing a good job, and you'll see the difference that an engaged operator can make almost straight away when they take on one of these businesses. So a couple of key metrics I want to call out. We talk about, obviously, really passionately about the speed of delivery, and one of the fastest ways to achieve that is to have one order per driver, not to give them multiple orders to deliver to multiple customers on each run. It's to send one driver with one delivery. And you can see in this example, it was only happening in the original case just over half the time. In the new case, it's happening close to 80% of the time. We actually would target close to 100% as being a target for us inside the ANZ business. But just through some of those focus, you can see a material reduction in delivery time and, in part, a massive improvement in NPS score. So a lot happier customers in this instance. So how does that then translate to the bottom line for that new franchisee? Well, unit sales up materially, 24.5%. It just blows my mind in a business that has the level of penetration that our brand does and the presence that our brand has in this country, that a single operator can go into one of our 800 odd stores with the same sauce, the same cheese, the same sign over the front door, and get that kind of increment in sales. And that's not an exclusive example. That's more common than not. And from a bottom line point of view, well, I think you can agree that that's a pretty healthy improvement for the unit economics of that store. The outgoing franchisee, more likely than not, would have said that their store was a lemon, it was a dud, there was no possible way to make any money. They were operating it as best as they could or knew how. The reality, however, is much different. In this second example, you can see, whilst the outgoing franchisee had reasonable operational statistics, they weren't able to achieve that at scale, and they weren't able to achieve that efficiently. And the difference from a new operator has come in. Well, they haven't improved all of those statistics materially. What they have done is shown how important and possible it is for a franchisee to grow their own sales. So you're seeing 21.6% compound on sales on the prior operator, and that's translating to a $70,000 improvement at an EBITDA level.
Why did that happen if those metrics didn't change?
Because there are two things. One, they're able to run the business more efficiently, so they're able to optimise their labour costs, they're able to control their food costs, they're able to then engage in marketing activities outside of the store, and those levers, still are a lot of that is still in the franchisee's hand to be able to control the amount of local store marketing they do, how they get involved with their communities, all of those things. You can't just execute your way to success. You've got to run a business like any other business, and that involves having a marketing strategy and investment in those areas and controlling costs. It's not just good enough to just have fast delivery if you're not controlling cost, as an example. So I want to now talk about one of our biggest investments in operational technology, Pizza Checker, and talk through our progress there and our future plans for that platform. So taking a picture of a pizza is not as simple as it seems. It's quite a complex process, and believe it or not, just on the Australian menu, there's millions of combinations that you could make from in a Domino's pizza store. And it might surprise you that over 60% of the orders we have today are customised in some way. So they're adding something, removing something, or building it themselves. So pizza is an incredibly customisable and personalisable experience. So then trying to develop technology that can tell you whether that's made well or not is also quite difficult. But what we've been able to achieve thus far is that we've been able to, with all of those variables, match the order that is in our point of sale system with what the AI is saying that pizza is, and get that to quite a high level of success. To grade that pizza based on some key metrics. Is the cheese the right amount of cheese? Is it spread correctly? Are the borders defined as they should be? And is the spread of the toppings how we would expect it to be? And then from there, there's a pass-fail grade and can identify whether a pizza needs to be remade or not. And lastly, a picture is sent to the customer inside our technology platform in real time so that they can see their pizza, they can meet it before they eat it, and they can see if it has passed our quality check. So I want to show you a video of what's actually happening with Pizza Checker as it's working above a cut station in one of our stores. And I want to point out that that bad number up the top there, it actually just means that it hasn't captured what it believes to be a full picture of a pizza. So you can see that what's happening is it's actually recording a video and using the AI to identify what it believes is a pizza. And then from there, once it gets a clean shot, it will make an assessment in just a few seconds based on all those metrics I talked about before, and pass or fail that pizza based on what it expects to be coming off the oven. So it's identifying things like missed toppings or things that are on there that shouldn't be on there, how well the pizza's made, even the temperature of that pizza as it exits the oven belt. So where are we now? Well, I'm really proud to say that right now, since the time we've launched Pizza Checker, and we get many, many thousands of pieces of feedback digitally inside our platforms on our product quality ratings, so really meaningful and material amounts of feedback, we've been able to improve the customer's perception of our product by over 15%. Our product quality is improved by over 15%. And in any time in my experience in this business, that we have been able to lift our level of execution or offering to the customer through a new offering or price, through improving our speed of service, or improving the number one reason they're coming to us, which is the quality of the product that they're eating, that has translated into profitable long-term growth for the business. And I really believe that this is a platform that's going to continue to help us do that. So whilst nationally we've lifted the numbers by 15%, that's not actually true of the whole system. There's the people who have adopted the technology early and who are really understanding it, working with it, and using it to better their business. There's the people in the middle who are using it somehow and sometimes, and then there's the people who haven't yet leveraged the full potential. So we have a lot of work to do there still, and I think that with that work, we will continue to see an improvement in the quality of our product. What's in the pipeline? Well, it's going to get better. It's going to get smarter. It can more accurately grade pizza with more variables. When we start to understand what the customer's expectation is as well, we can start changing some of those metrics. We will be able to really engage our teams through real-time reporting on this. Right now it is a standalone tool with some reporting that's happening on a daily basis and some in real time in dashboards, but this will start to permeate throughout the operations of our store, where we're getting real feedback to the people making pizzas in real time so that they can understand where they need to improve, how they can achieve more, they can compete with neighbouring stores or stores within their group. We are building a lot of technology around how we then get this into the hands of our team members so that they can do more with it. And finally, I want to share just how proud we are of our new app that's currently in test and that we'll be rolling out in the coming weeks. And it's been a lot of research, a lot of work, and I really think the team has been able to pull off something here that's world-class, that meets our current customers' expectations of speed, of personalisation, of smoothness, and it really is a big step change from where we are now. So we're currently rolling that out through a gated process, making sure we get it right and it's working as it should be. But that should get into market in the coming weeks, and we're really proud of that product built right here in Brisbane. So with that, I'm going to hand off now to Josh.
I guess I think my main job here is just to reassure you that I guess the same strategies that work in DPE across all the countries we operate in are virtually the same things that we're doing in Japan. So it's not this this outlier. So I'm going to do my best to explain what we're doing in the market. It is centred around fortressing, Project 310, but for those who haven't seen it, I'm going to give a bit of an overview of where we are or what the pizza market is in Japan. So let's kick that off. This is the delivery pizza market in Japan. And you can see largely, historically, it's been pretty flat, but what we're seeing now is some category growth. And simply put, Japanese are eating more pizza. And what's interesting about this graph is this is all about store units, or, it doesn't actually represent AWUS. So we're really confident with knowing what we know is that we're actually seeing AOS sort of grow as well, which means even more people are eating pizza within these numbers right here. And that's allowed us to sort of hit a 26% market share of the delivery pizza market, which is quite a commanding share, based on, if you think back to 2007, we only had 180 stores in the marketplace, and now we've got 600 plus stores. So what is this delivery market? Well, interestingly, delivery of food has been around for quite some time. One of the largest delivered items in Japan is bento boxes. And it's very traditional. They'll actually deliver all the cutlery and everything and then go and pick up all the cutlery at the end of it. That is the biggest. And then growth in sushi delivery. If we talk about pizza, we're 10% of the delivery market, and we're 3% of that 10% for Domino's. Fast food, if you want to get some context of our size, it's they don't actually track QSR in Japan. They do track fast food. And McDonald's, who's publicly listed over there, we can show you here that we're 1/12 the size of McDonald's, and we're about 1/5 the size in terms of store count. But lots of white space to grow. A 3 trillion yen market, and we are sort of growing that market for us in through pizza. So, what's going on in Japan? And one thing that wasn't in Japan is, I guess, a look of it has a lot of legacy. And originally, when Japan started, or Domino started in Japan, it's very high priced, and it's really centred around a couple of occasions. And these are all the occasions here that pizza could be enjoyed. And we only focused on these two down below here, which is special occasions, birthdays, Christmas, New Year's. And as you know, that everyone only has one birthday, and Christmas, there's only one Christmas. And we really like to sleep at night, and we don't want to sort of wake up thinking, I hope someone had a birthday today, so we sell some more pizza. So a really unbalanced view of the market, in our view. And this is why we started thinking about this barbell strategy. And through our research, there was a lot of tension points, a lot of barriers to ordering pizza. Firstly, we had perceived long service times. And even though it wasn't actually that long, it was still perceived long. And then we had high cost. And as you know, with the value equation, that's just all out of whack. We also had another interesting piece of research. We also had menus not designed for individual purchases or individual occasions. And when we look at that, that's actually 40% of all the consumers. So 40% are meal as a task, as it is termed by the research. There's also some perceived unhealthiness and an unbalanced, an unbalanced meal. The bento box style, where they have lots of different textures and flavours and different ingredients, we were perceived as unbalanced. Another really interesting piece of research is what people expected from us as a brand, as an American brand in Japan. They actually expected us to add to their culture by bringing in authentic experiences to Japan. It's very isolated Japan, very monolithic society. But they expected brands like us, as well as McDonald's, and to bring them authentic experiences. So with all this together, the answer, we had to come up with answers for each one of these tension points, and that's what we've been doing over the last couple of years. And we've done that through different ranges, different pricing models. You'll notice down here, this is the American Classic range, so bringing authentic experiences to Japanese customers. Pick up at 799 yen, and we've also split the pricing model and delivery at 1800 yen. And then we've added things like New Yorker range, another authentic experience at Domino's, only from Domino's. And then at the other end of the barbell, we've got things like Superstar range, really focused around quality. Not to say that these other things aren't quality, because we're still using same dough, sauce and cheese, and we spend a lot of time articulating that there is no quality change within the menu offering. But this allows us to access many, many more customers throughout the market. And if you look at the suite of new things that we've launched in Japan over the last few years, you'll start seeing, you'll notice that there's a real focus on the food, and about the quality of the food. Before it was sort of strange characters that would jump across the screen, and which are quite cool to watch, but I don't think we sold a lot of pizza. But now we're back talking about the food, but moreover, we're talking about layers, thick shakes. No one's delivering thick shakes. 1 kilo New Yorker cheese, it's on TV at the moment. Superstar. And the other thing that we've picked up on is that in Japan, seasonal changes are really, really important, as too are the certain dates within the calendar. So you'll see up on the right-hand side there, colourful summer. The change of a season is very important in the psyche of Japanese. So we make sure we emphasise that through our marketing. And then we've got things which is down the bottom here, like tsukimi. And tsukimi is just one example of a date that's very important to the Japanese consumer. And this is the celebration of the Moon Festival. And we do a pizza that's got, quality eggs, really nice eggs. And we celebrate the moon with them. So we give them an option when they probably would have been eating soba noodles at that time. And there's lots of these little occasions that we're just, being more relevant in. I mean, this wouldn't be a TV campaign, not for 2 weeks, but we're just being more relevant from a content point of view. And I think, when we look at this and we look at key success factors, we measure it on how many new customers are coming in. And with the barbell strategy, it allows us to protect all the hard work we've done over the last, it's 35 years next year actually, over the last 34 years on building this brand, and just allows us to protect it without killing ourselves at the same time. And we can see the success because it's bringing in a whole lot of brand new customers we never thought would be in our stores. So coupled with that, we also are building a lot of stores, and I wanted to give my context on, the fortressing strategy, because I think it's good to balance it across all markets. And I'm going to give an example around Nagoya, which is a market that we've been working on for some time. And when DPE bought into the business, we were about 12, 13 stores in Nagoya, and probably thought we were doing a pretty good job, I'd say. But we ran through a process where we had a look at the market, and we had to identify, obviously, the stores that we had built and look for ways to optimise those areas. And I can tell you now, after looking at the numbers, we were north of 120 to 140,000 addresses, so quite a lot of addresses in there. And we had to look at those and go, well, look, which of those stores do we need to relocate? Because we had this whole delivery model. We weren't on the high street, so we were going sort of from the back streets. Same strategy as Tokyo and the whole way through Japan, and put them on the high street. So relocate and then optimise the territory. And of course, we had to build out the white space as well. So we identified a range of new territories. And now we operate around 53 stores in Nagoya. And this is what it looks like. And this is what fortressing means for us. If you look at the original territory, we're about 6 more stores. So what's that? 19 stores in a territory that was previously 12, 13 stores, and still a long way to go. And the same sort of graph is what Nick and Andre showed, is that materially it has actually benefited our business. Obviously we get closer to the customer. We get a lot more carry-out customers. And one thing that's interesting about Japan is, whilst here in Australia and probably Europe, everyone's got a car, but people don't have as many cars in Japan. It's just more efficient transport systems and subway systems. Another interesting thing is they actually don't carry food on the trains as much as you think because of the smell. It's disrespectful for some people to carry the smell. So getting closer to people and their neighbourhoods is actually critical for us. It's a lot more dense than probably any of the markets we operate in Europe and in Australia, of course. So 1 square kilometre could have upwards of 50%, 60% more people, or even double in some cases. So good news story for us is that we also, by building out and fortressing these markets, and we get onto TV, and TV is a big accelerator for sales, for any of our businesses. And Japan is quite unique, where Andre said that Germany, I might have been Don, said that Germany is just one TV market. We've got 57 different prefectures and 57 different TV markets, and it requires a positioning in that market to be number one before we can actually afford to go onto TV. And we need a certain multiple of stores to get there. So if we think about Nagoya, and this is how we think about the business, and this also helps me answer some of the questions around, well, why aren't you in these other territories, these other prefectures? And the reasoning behind this is that when we look at what we have to do to get to 100% TV, or 52 weeks a year on TV, and this is only at a base GRP level, we actually have to build a lot more stores in the existing territories that we're in. And for instance, if you look at Greater Tokyo here, we need 118 more stores to get to full TV. So I could go up here, but the tyranny of distance, the cost, it means that we wouldn't be able to leverage our overhead like we are now. We wouldn't be getting closer to the consumer, and it wouldn't be the right move for us. Now, that's not to say that we're not going to go there, and the opportunity is 16 million more people, or nearly the size of the Netherlands, that we could access. But right now, we're focusing on building out these markets and leveraging what we have in those markets, leveraging everything we can. And of course, you get all the freight economies when you build out markets like this. And if you look at Nagoya, we're already at full TV levels, and that's been meaningful for our sales in the market. So hopefully that gives you an idea of what we're doing. And as I said, it's not to say we're not going to go to Hokkaido, but we're just spending our time to build out these markets right now and fortress these markets so we can leverage everything else in the business. And remembering also, we run a big corporate business, so leveraging our overhead from a corporate store business is very, very important to us. And that's why places like Tokyo and Osaka, it makes sense for us just to build a lot more stores in these areas. And this feeds into, obviously, our strategy around Project 310 and all the things Don spoke about, all the different projects we're part of, we're benefiting from, And we've already got 14 stores that are sub 10 right now. We've had our corporate stores be at 19.2 minutes for the month, and we sort of average around 22 minutes. But there's still so much to do, and so much white space and stores to build, and those projects that Don talked about is going to be really, really exciting for us. But one we are focusing on quite a lot is our e-bike strategy. And we plan to be 40% e-bikes in Tokyo, and we actually plan that for Osaka as well. There's not too many things you can find that have just so many wins across so many different dimensions of your business, and certainly a win for the customer. And if you know Tokyo and Osaka, there's a lot of traffic. We can avoid all that and park right at the door of our customers. We obviously get a win because it's very high employment in Japan at the moment. So being able to access some younger people and also access females on e-bikes, we have less accidents, and it's actually more efficient, and that means we actually save money from our operating structure as well, because it's actually just cheaper to do that. So win, 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 win. So it's a no-brainer for us. We want to get to 60% in the coming years. And of course, technology, we've got the same technology as all the other markets. Some things that, it represents 15% of our sales now, all our owned media. So this is, very cheap for us, once we own all this media. And we've launched things like Coupon app, which is the same as Offers app in Australia. And we've already had 900,000 downloads, and it represents a meaningful part of our sales. We've also got things like Coupon Box, which is, which have got millions and millions of people using and actively engaged in it, which is kind of a little bit different to the other markets. But we're just really using technology and leveraging off, the One Digital platforms, very much like all the other DPE markets. So Japan is no different. Exactly the same strategies working. People are eating more pizzas, and there's a big runway for growth there. But that's about my time. So I'm going to pass back to Nathan to wrap this up.
We've given an unprecedented level of detail today in this session. My goal in doing that is to really answer those key questions that we get. These are the most common questions that I get from investors here and internationally. It's not my expectation that we will continue to provide a rolling update on the percentage of this penetration or that, because it's, we're talking really about thematics. But I'm happy to answer those questions, and we'll put forward on ongoing investor presentations the thematics that are really answering those key questions. So that's the intention going forward. The other thing is, I do also stress that we did say, we've been consistent now for a year, that we're not providing guidance from this point, which also means we won't be providing a de facto guidance. I'm sure there will be questions of that nature coming up, but I'm flagging that up front, that we're not providing a de facto guidance today. So maybe if I start over here, Ben.
Yeah, thanks. Just a question for Andre or Don, just around Germany and France specifically, in sort of two parts. So maybe, I think you previously said you probably need about another 100 stores. You talked about sort of 50 to 60 stories, 100 stores before you get scale. Is that still how you think about that? And then secondly, I'm just interested, particularly around France, around the rollout opportunities. It's probably been a little bit slower, and I think you talked to doing record numbers of openings this year, so more than that 26 odd stores. Why don't you push more corporate stores in France and Germany if there's just not the appetite from a franchise perspective at the moment? So two questions.
Yeah, well, you can start on the penetrations of getting to reasonable television in Germany and France, and I can talk to the corporate stores.
Yeah, like I said, there's probably regions already in France and Germany that are better penetrated than some regions in the Netherlands. But it's just so big, and it's a single TV market, so it will take us longer to get the penetration. I mean, the northeast of France is really well penetrated, and in almost you look at France as being 5 Netherlands, and what if you had put all the weight that you put into Netherlands behind 5 different regions? Is that the way that we can grow faster? But we also have regions where we have little stores. We still think we've said that we'll have a record store openings. A corporate store, obviously we brought Andrew Bradley in, our new CEO, who used to be a franchisee. So we've already added corporate stores. But corporate stores and franchise stores, the one thing that you need is good people. And you need to grow good people. And Nick shown in his presentation how important it is to have the right people in there. So we're growing a bigger base, and we're growing from a bigger base, so there's more accessibility to good people. Locations is not the thing that holds us back. It takes on average more than 12 months to open a store in France. That's just the way it is, and we have to deal with that. That's why we also can be more confident in saying, yes, we will open a record number of stores, because we have that pipeline. And if we hadn't had that by the beginning of the year, we would never have opened, be able to say that we'll open those stores, because you know that it takes permits, utilities. To have gas in a store takes ages in France. To be able to put up a sign on a heritage listed location in the center of town takes ages. So we know that we're going to open those stores. Does it answer your question? Or?
Yeah. And we are going to build a corporate network. So
yeah, we are building a corporate network.
We already have a meaningful number of corporate stores in France.
Yes.
And of the record number this year, some of those are corporate stores, largely in Paris, where we're going deeper into Paris, and we're in conversations with franchisees in Germany that will become some of our corporate, because that's our model, right? CEOs come out of our franchise culture, and they often start running our corporate stores. So that's absolutely it won't become our lion's share. We are still predominantly franchise, exception of Japan. But yes, it will become a piece of it.
And it's about 100 incremental across both France and Germany before you really hit that point of scale still?
Germany's a little bit more. France will get there a little bit sooner, but Germany needs closer to 200 stores to get some critical mass, because we're buying the whole country. The good news about it's not all wasted. We talk about the inefficiency, so it's not efficient, but it's not wasted because now there's a pent-up demand when we're opening stores in France. Because we've been on television for over a decade, be it not big, it's a market, it's a brand, and it's the one thing that stands out to me is the amount of young people that you see in our stores straight away. Like really, the hipsters and so on are in the French stores immediately, and then the families follow the youth. Because you can imagine in any town we're opening up, there could be 12, 15, 20 pizza stores, or trucks or whatever. So there's pizza consumption, the early adapters are straight into the youth who've been watching television and following the brand, and then families follow.
Hi, it's Andrew McLennan from Goldman Sachs. Just to follow on with Europe. I guess reflecting back on the earnings trajectory, you still had strong growth the last few years, but certainly is disappointed versus expectations. It really does appear now that France was a big part of that disappointment. Can you just go back and reflect on what went wrong and why it's changing now? I mean, obviously you're coming out very hot with store rollouts in terms of what you've been suggesting here at the result, but why was it such a disappointment, and was that the majority of the miss in terms of your own expectations?
Yeah, so the history of France was that we bought these businesses, the three countries, and the net of the three were losing money, and France was no exception when you and had to start paying royalty. So in the first few years, when Andrew Rennie ran the market, we actually had extraordinary growth. Operator driving the business, and some of it got taken out from the royalties coming in, so that diluted what the look of the earnings were. But the real profit was quite material during that time. Andrew returned to Australia, and then we made some fundamental mistakes in that we didn't have an operator to run France. It's the one exception out of all of our businesses. We now have an operator in Andrew Bradley, an operator being an ex-franchisee, one of our most successful franchisees. And he came in last year and asked us during the year for support to really get the franchisees behind him. And he said, look, if you give me some support, I think I can rally the team and show that I'm their guy, and that he's asking them to do things. In return, he's going to give them some things, and we gave him that support, and that's what really diluted our earnings, because actually the rest of Europe performed exceptionally well last year. So this year, why we're so bullish is that we've wound back some of that, so that's immediately just the tailwind that we just banked because it's just winding back some incentive. And the evidence of that incentive is fueled is that you're seeing the stores open now. So the people signed up as soon as those incentives came on, and those stores are now opening.
And there was a direct link between the two.
A direct link between the two, between support and opening, and confidence and belief in the business. Andrew's internal conversation is, we've got a bit of a hill to climb here to get this fired up again. If I can just drop it back a gear, please believe in me, and therefore I can shoot forward, and that's what we're seeing now. So we're seeing the best like-for-likes in a while, and which we reported in August, and now we're going to. Shareholders are not going to wait. You're going to see in February. In fact, you'll even see at the AGM, you'll see numbers. So first time ever, to be fair to the global network, we have a lot of foreign investors now. And to be consistent with disclosure, at the AGM, we'll actually break out every country individually, store count and stores open for the year live, and that will become on our shareholder website from the AGM. It creates all sorts of new, for those that are think week to week in our business, why haven't you opened some stores here? And we open a lot of stores in December, and we open a lot of stores in June, and over time that will illustrate itself. So for those who look on a day-to-day, it will create new problems for us because it's like, whoa, but half to half, second week of Jan, all the stores will be in there. You'll already know by the time reported to market. Same thing in August, because they're there. They're the stores that have opened. And you'll see that transparency. So you'll see it happening in France. On the vice versa, Germany just converted a lot of stores, so it's winding up its machine. Not as many stores in the first half, a lot more in the second half, because it's just winding up its machine. But we'll also have a record organic growth year that we promised. So.
Can I just follow on with France? So you've spoken about the leverage from media, but there's also the leverage from your commissaries. Can you just quickly talk about what that means for the franchisor margin in France as you build up that scale? In addition to unwinding the incentives, there should be a fair amount of operating.
Yeah, so Andre's he's run the commissaries, so he can...
Yes, so the commissaries, obviously, if they have more stores, they become more profitable and they're also more effective. Big thing in France is where do you open the stores, because the big cost in France compared to the Netherlands, where one commissary does Netherlands and Belgium, the furthest route is 200 kilometers away to the south of Belgium, and to the north of Netherlands. Transport is our biggest cost, so we only have 2 commissaries in France now. They will get more efficient with more stores, but transport is a big piece of that. So it depends if we open, and we won't, but if we would open all our stores in the south of France, you won't see a lot of additional profit in the commissaries. Do we open them closer to the commissaries? And we're having models when are we going to open our third commissaries, because we do expect that our penetration in the southeast will become so good that we could open maybe not a commissary that produces dough, but at least a distribution point that we can produce dough in one other and then transport that to the commissary. I guess that will happen in the next 2 years. To make them very efficient, we need more commissaries, and we need to look at transport really closely. But once again, it's a really big country. We are not evenly distributed through the whole country yet. And in time it will happen. And you'll see some of that this year, but not to the point where Netherlands and Belgium is really, really efficient.
It's all scale and leverage. The first slides.
Yeah.
That's how we've always built a business, and yes, you'll see it flow through. There's these little hiccup times when we maybe move to a new commissary, and there's some expenditure and relocation that can happen. But by and large, yes, scale and leverage, as long as we keep the stores close to that facility.
Hi, Mr. Jeffries and Corey. Just a question around DPZ's comments recently about 3 to 5 year targets not being relevant anymore. Why do you still think they're relevant for you?
Yeah, but we've got a lot more green fields in our business as a whole. And so, when we look at the amount of stores that we think we can open, when we look at what we're seeing from the technologies and the plans that we're rolling out, 3 years to 5 years still feels very comfortable to us. Now, that's always, it's not guidance, it's an outlook. So in the event that something shifted, then we would also look at changing that outlook to keep shareholders informed. But right now, and I think the other thing is this real energy and focus is giving us even more confidence behind some of the store growth. Because when you look at those numbers, it's by and large 2/3 store count growth to 1/3 same store sales growth. And so, yeah, the store count gives us so much confidence because there's so much to open.
And obviously their comments on aggregators are really negative. What do you think makes them profitable for you that wouldn't for them?
Well, you can imagine in a large system like Domino's, and that we are pretty closely tied to most things, but every now and then we have a difference of opinion, and that can often end up in, for example, what Andre highlighted. I too had a different opinion, and Andre and I used to have, vicious arguments. Andre, turn off the aggregators in these stores, and he'd say, I'm losing all the sales. That always speaks to me. We don't want to see sales go down. And it took, Andre's educating our whole global business because he's had the aggregators for 15 years. And so some of us, we thought of them as enemies. We don't see them that way. We see them as frenemies today. And no different to Google, no different to the social media platforms around the world, in that ultimately it's a place to go fishing. The digital universe is quite big and organic. It's not for me to comment on the US, but markets grow at different times and different dynamics, and we're not in that market. We don't look at their data. We are responsible for our markets. We're responsible for, that's the benefit of master franchising, is we're local, we have local teams, and that defines the way we deal with it. So we just have a different set of circumstances in front of us today, and which is making it a different outlook.
Also, if you look at the Domino system globally, in most mature markets, same-store sales growth is
Yeah, so well, as we've tried to highlight up there that, over a period of time, we recover the original store sales and we've got another whole store. So, the average you saw in the most mature market like Australia at 211% illustrates that, what we see, and if you look at that graph closely, you see that within 18 months, typically you're pretty close to an additional, you've got the original store, sales back in the original store. And what Nick's tried to highlight more in his presentation was the biggest variable cost in our business today. It used to be food, it's now labour, and that's pretty well across the world. Wages globally have climbed, no more so than in Australia. And so, when if you can imagine, drive times are there and back. So if we used to take 8 minutes, which used to be our radius, so it's 8 minutes there and 8 minutes back, and if today a minute is 50 cents, when you take a minute off, a minute drive to, you're taking a minute off on the way back, so that's 2 minutes, that's quite material. And that flows straight through to the bottom line, and then ultimately, even more than that, it's customer-centric. The customer gets a far better experience, they get a hotter, fresher pizza. We get more deliveries per driver, so we can therefore justify to pay more, because one of the battles globally is being wage rates, period. There's not enough human beings to deliver the number of deliveries that are going to be required in the next 7, 8 years for all delivery of retail. There just isn't enough people on the planet, which will put more money into automated and so on. But in the near term, therefore, we just have to be the most efficient, and we already are. We do more deliveries per hour than an aggregator as a comparative, and our focus inside is to keep climbing that up. So that, because obviously you're dividing the number of deliveries by the hourly paid, and that makes that cost lower and lower. And marketing is massive, because the efficiencies of the ring of marketing, it's still surprising to us. Print is still the second most effective media in our business. In fact, in Japan, maybe the most effective still. So print is quite expensive, as you can imagine. And the further away from the store, the lower the ROI for the print, because you're dropping to a consumer who knows that they're getting a lesser experience. So you've got the closer to the store, the more effective the print. So when you've got smaller delivery areas, you're not wasting, you're not getting that dilution. So between marketing and advertising costs, that's by far the biggest. In moments of time with cost, which Australia's experienced, right now we're seeing very good growth in franchise profitability, and we'll be able to talk about that at the AGM. So we're seeing the best growth in franchise profitability in a couple of years. Because these efficiencies are applying, and we've normalised, we've stabilised, and now we can go on again and grow. So yeah, works for, ultimately, franchisees wouldn't be opening more stores if it wasn't. During moments of weakness, we haven't. So you saw Japan 2 years ago, we weren't opening very many stores for a moment of time because our earnings were not as strong and our like-for-likes were not as strong. Australia, like-for-likes not as strong. Franchisees didn't open as many stores in the last recent period. And then as soon as that like-for-like flows up, you see the stores. They flow in Australia 6 to 9 months later, Europe 12 to 18 months later, Japan, the most efficient, can open a store within 3 or 4 months. So it happens a lot faster. Yeah.
Just on the point you made earlier about fortressing and understand the cost-saving dynamic, the franchisees put more capital in those as well, and there is some fixed cost in the business plus some variable cost that's new as well. So how long does it take for the franchisee to wash his or her face on a return on investment perspective or an EBITDA margin?
Yeah, so the best thing is because it's incremental growth for us, we give significant waivers in the beginning. So that's how we safety net the franchisee. So straight away they get royalty and advertising waivers, and it varies by market between 18 months to 3 years. So what we're saying is, look, we're going to take all the risk out for you. We're going to give you these really material waivers. Sometimes they wind off, sometimes they're just up to an amount. Like they could be, we will give you equivalent to until you reach 100,000 or 150,000. Now, but that takes you 6 months or 3 years, that's your money to take back. So that helps to de-risk that period. So by and large, take out the first, say, 5 or 6 weeks of training and instability in the business that happens. By and large, franchisees, the reason they're doing this and the reason it's happening, how many stores were open last year? 179 stores last year. They're nearly all opened by internal people. So their franchisees are taking these incentives because they know that the ROI is worth it for them. Now, your question on ROIs around the world, well, they vary between 2.5 years and 4.25 years, depending on the geographies. With our long-term Domino's global goal to be at 2.5 years, and that's what we strive to. We don't make that as a guarantee, as an investment in our business, but it's what we know that at anywhere around 3, you're booming. So if you look at stores that are opening a lot, countries opening a lot of countries, they're probably close to 3. With Japan, once again, the exception, because 4's even amazing in Japan relative to anything in the marketplace. So at 4, they're opening a lot of stores. When we were out towards 5, not as many stores opening. But the rest of the businesses, if you see a lot of stores opening, you probably think that that market's getting close to 3. And if it's not opening a lot of stores, it's probably stretching out. Like for likes aren't there, costs are in there, maybe a VAT increase, a labour increase, something like that, which has pulled back some tension on the business. So, sure.
Yeah, Sean Gunn, excuse me. Just 2 questions. Just one in regards to Holland. You said Holland has the highest EBIT margin, or sorry, pardon me, Benelux has the highest EBITDA margins in the group. As France and Germany have a lot more runway to grow, how should we think about that mix benefit or mix headwind in terms of country mix playing out? And then how does that sit relative to operating leverage that you should get out of those other markets as well, please?
Well, second to the Benelux, by the way, is Germany right now. So all the stores opening in Germany, it's really beautiful and how that flows through. And France, only because we've given them support that's being less, but as that support winds back, incrementally, there's not that much difference in margin per store. It's just the size and scale of overhead to markets, if that makes sense. The one thing the Benelux has over every single business in our company is that the whole of the Benelux can be covered in a 4-hour drive. Population of Australia and New Zealand. The efficiencies of that are extraordinary from commissaries, from executives. For Nick to fly to Perth 6 hours, 5 hours, whatever it is, from Brisbane, flying, and a lot of cost, getting Perth franchisees to meetings and so on. So, Andre, you want to add to that?
No, it's exactly that. There's nothing special about the Netherlands and Belgium, just that it's really efficient to get around, drive around. We can do more visits on a day to stores for operational checks. That is what it is. It is just really efficient. And we've had the headwind of that labour in general in Germany or France, if you do that comparison, is higher than it is on an hourly basis than it is in the Netherlands. But Netherlands is catching up there. Still, highest EBITDA in the system.
So the Netherlands does have the lowest overhead per metric we can compare in most things. So number of consultants per store, number of trainers, number of OER, which is our audit team, typically lower. If you look at the United States or the UK, they're at another level that they achieve with economy of scale when they get to size. So France and Germany probably will reflect more those models over time, that they actually probably go past the Benelux because it's real size and scale. Germans and French eat a lot more pizza. It's just the time frame for investment a lot longer. So, Germany and France are not going to hit those numbers in the next 3 years. It's a much longer build out to the big numbers that we think we can achieve.
And my second question is just around ANZ. It didn't appear that the Tastelink 30th December promotions really worked that well. I just wanted to know, what have you learnt from that in terms of where that was a little ineffective, and how is some of the sort of price creep that you're engaging on in the market going on in terms of lifting $5 pizzas to $5.50 or $6? How has that worked in terms of that impacted volumes, and has that proved a more effective way to help franchising profitability than try and mix shift to higher baskets, which would appear to be an aim of the promotions and the campaigns that you launched in December last year, please?
Yeah, so I guess if you look back on it in hindsight, we did throw a lot of things at it, and there's a couple of byproducts of that. Is that, well, one, you don't give any one of them probably the desired or the right amount of attention to flourish and achieve the right kind of return for the business. And you distract the system quite a lot too when you've put so much change in. You see people struggle to get to that level, which impacts execution and focus and those kinds of things. Actually, what's working really well for us is shifting people into a higher basket, if you like, or a more premium product. And we highlighted at the last update, just how well delivery and digital is going for us, and that's predominantly off the back of getting our delivery offering right. And as part of that, we're getting material lift in ticket too, and price. So that has worked quite well, and is one of the things that continues to work quite well for us. What we highlighted where we stumbled a little bit was tinkering with that lower end of the barbell strategy and that value offering, and that confused people a little, and a lot of that now is in the process of being unwound, and we're seeing that as a strategy work as it has in the past. Yeah, so what I'm saying is that bottom more value end offering where we did tinker with it wasn't effective, didn't work as we had intended it, and that is what we're in the process of rehashing and going back to what we know does work. And it's always a tension, and it's one of the things that's easy and nice to be able to go to the business and say, look, we're gonna sort of let a little bit of steam off here, but the reality is we have to look at what the market is telling us, and the realities of that is, well, there's a consumer that is very frequent in that segment, and they're very sensitive to that level. But that works if you can continue to grow the business in other areas, and that's what is working for us.
Richard?
Hi, Don and Richard from Scholz. I wanted to ask you about you touched on greater access to new markets, and looking at Luxembourg and Denmark as recent examples. I mean, no existing business in there. I mean, Denmark was interesting one. They did have a bit of a food scandal that led to their demise. My understanding is that historically DPZ would allow you to take on some difficult markets in most cases, and you obviously steer away from those. Can you just like to hear a little bit more explanation around what this greater access actually means, and then for you guys in terms of what markets you would consider, what types of markets, and perhaps the types of markets that you absolutely would rule out.
Yeah, we don't want to overplay Luxembourg because it's really tiny. It's not even the size of part of Munich. So it just filled in a gap. So that will, it's just straight off the Benelux team, really simply, it's part of the Benelux. So in fact, the first franchisee is a Belgian franchisee that's got a store just across the border, and he'll move his team down there and open his store in the next few weeks. Denmark is also benefiting a lot like New Zealand and Belgium does from the Dutch team. So when we have a centre of excellence like we had for Australia, for New Zealand, and then a lot of the Aussies travelled overseas to start up, and now there's not very many Aussies in Europe anymore. The same thing's happened in Europe. Is the Dutch have been so successful, the German CEO's Dutch, the Belgian CEO's Dutch, who is also the Luxembourg GM. And Denmark is an Aussie lady, in fact. She's from Toowoomba. She started as a pizza maker for me many years ago, and she's been growing through Europe, and she's now the CEO of Denmark. And she's really leveraging Andre's, the Dutch team that was originally there. So we can do that. It would be highly unlikely, you never say never, if the opportunities, we think we can map it out. It's highly unlikely we would open a brand new market in an unadjacent country, especially if it was large. We did Germany because we acquired 2 chains and benefited from the Dutch team. So the Dutch team really helped Germany. Now that's slowly pulling back as we're building up muscle memory and team expertise that are German. Quite a lot of Dutch people running around the German business in the first couple of years, and now a lot less as we really have German muscle memory being built there. To answer your longer question, without being specific, we do love adjacent countries because it's just such a nice fit. But if it was ever possible, and not saying that it is, we wouldn't rule out going to another region of the world like we did with Japan if it was size and scale started with something that we could take.
Part of your point that DPZ could get the handbrake on you, because I thought historically there's been a sense that they didn't want you to be too big.
Yeah, so what we're trying to avoid the last 12 months, and particularly the last 6 months, and hopefully strongly reinforcing today, our limitation is our ability to execute. That we don't feel any, if we're getting a new country, it's for us still opportunistic because the doors are now open in certain places, and if we deliver on those, then maybe other doors would open in the future, maybe. But, look what Josh just put up there too. There's 16 million people in the north of Japan, the size of the Netherlands almost. We don't even have a store yet. I was in Munich last week, and it's bigger than Brisbane, and it's got 12 stores. We've got 80 stores in Brisbane. And people like pizza in Munich. So there's so much opportunity in what we've got. As long as we continue to deliver against that, and we can show a team and a business case for the next place, because capital, execution, business plan, people, then those doors open up. But, it's not like we're urgently hunting those right now too. We're being really focused right now on certain things. And, you look across Japan, we're market leader in Japan, but we're not market leader in every city in Japan. And we've got all these cities where we're underperforming there's so much return for both the franchisee, corporate store, and a shareholder in DPE to really penetrate those. So yeah, what we're trying to avoid today is execute well of what we got, and as opportunities, the doors are open. It's all about, if we stumble, those doors don't open up, and so on. So,
especially thinking about aggregators, is there any way that delivery aggregators can follow your lead on that?
yeah, look, we're in a disruptive world, so we don't know what's often they know and what they may be working on too, right? And these are often very well-funded businesses, so one can assume that it's on their radar. They would know the exact same data we know, that improves. And they do love having Domino's in there. As soon as it rains, contractors don't turn up. And Domino's goes straight to the top of the algorithm every time because we got all these drivers that are paid employees, insured, loyalty members, part of our team. We rock it in some of those days, like you wouldn't believe inside those platforms. And then it is variable by market. You see these maturity cycles, like we often see bursts where service is improved and then we watch it drop away with the aggregators. They start to struggle on the reality of how they're achieving, because their models are almost conflicting in that they need more drivers, but then the current drivers get less deliveries, so they're less happy. That's not the case for us. We're a dedicated team. That's not a tension in our business, because if you're not doing delivery, we've got a lot of other work for you to do. We've got dough to be made, we've got cleaning to be done, we've got structuring, we can even go out marketing. There is no reason to be nothing to do at Domino's. We can productively use every single team member in our business and are getting smarter and smarter with our intuitive rostering systems and so on to even get better at that, about what we should be yielding our team members to be. So long story short is that I think that we're showing that we're the best delivery times because we are so focused and we're delivering on these, but we don't live with the idea that our competitors aren't going to strive to get better as well. Of course they're going to. It's the business. You have to get better. It's going to be a lot harder to aggregate three separate, you've got a restaurant, different proprietor, contractor, different proprietor, platform, different proprietor. It's not impossible, the world's smart, but evidence says it's materially harder. Three different minds.
Sorry, perhaps, sorry, Johannes, thank you for that. So maybe if we, Nick, if you could potentially talk about maybe sort of some of the works we're doing in terms of smarter kitchens as well, because I know we've sort of spoken to the focus of that end-to-end proposition.
Yeah, and I think also, in addition to Don's point, is that all of those things and technologies is no doubt going to improve the way all businesses can be efficient in those areas, but fundamentally, without actual penetration, I don't know how you leverage that, because it's not like you're picking up and dropping off human beings that are all evenly spread across a certain area. Restaurants typically are centralised in their locations. Homes tend to be centralised in other locations. So I don't know how you get the efficiency of getting from A to B without actually getting from A to B. There's ways you can improve around that, but that to me is the single biggest point of leverage, and I think that's where this fortressing and all of this really comes into its own. In addition to that, it's not just about having that kitchen closer to the customer. It's, well, then what you're seeing is that to be successful in that new economy of digital and food delivery, you need to be efficient and be able to extract value from the store level operations. And that's where you're seeing a lot of media around unsophisticated operators aren't able to do that. And we're really passionate about investing and giving our stores not only the right locations and territories, but then harnessing that with technology that can actually improve the payback or the time that a team member spends on a task. And we're investing big in scheduling platforms, and Pizza Checker is one example, apps for our team members, all of those kinds of things, which then give them benefits to be able to execute ahead of and extract more value at that level of the business.
You use stores per head of population a lot as a guide for us thinking in terms of eventual store numbers. But if I sort of looked at an example fairly close to home, you have significantly more stores in Brisbane, for example, than you do in Melbourne. And so maybe you could just use that example and just talk about what makes Melbourne perhaps harder to open stores, and has made Melbourne harder to open stores, so we can sort of understand a little bit better that guideline you're putting out there.
Yeah, well, I think that's a really good question, and the point there that you make is a valid one, is that we aren't as well known and as penetrated in a market like Victoria as we are here in Brisbane, but we also weren't as penetrated in Brisbane as we now currently are, and those two things go hand in hand. You know, the example I showed earlier today, you know, that territory would have made sense in the current level of population with the economic, the economics of that business of that time and the level of penetration that the brand had in that market, its ability to put media out there and to get effective ROIs on print. So, you know, that's why I try to demonstrate today that, you know, whilst Queensland is one of the most penetrated markets in our business, we're not at the end of the road there, nor do we expect Melbourne will arrive at that same place at the same time as Queensland. So it will follow. I have no doubt that we can be much more penetrated in Melbourne than we are today. Will we get to where we are in Queensland by 2028? I don't know, but we don't need to, because we actually have other markets that are getting even more penetration, and that's what enables us. And I think that's the problem, is that we look at these big numbers and then we just average them out. The reality is that, you know, they're markets within markets, and there are different anomalies that drive each one of those.
And just quickly, on the poor performing franchise stores, if you took into corporate ownership, can you comment at all on progress in terms of transitioning back to franchises?
Yeah, so as we highlighted, most of the heavy lifting we think is done in that area in terms of the absolute number of corporate stores we're carrying. In terms of being able to successfully refranchise those out, it's pretty much the same equation as getting new stores on the board. You know, once you can get that confidence back in the franchise base that there's sales there, that the economics are there, then that speeds that up or slows it down. And, you know, it doesn't make good sense for us to try and push that if it's not the right issue. First and foremost is making sure getting the right operator in who can be the best owner of that store over the long term. And, you know, Australia's a big place, so, you know, we might have a lot of good operators up here and a lot of stores we want to refranchise down here, and, you know, it's not as simple as just sort of doing that straight swap. So, you know, we have to be patient and make sure we're investing in those markets to build out the bench strength in each one of them, and that's what I'm really focused on doing, because the results are very clear. You know, when we get it right, you know, a lot of the things we call problems just go away.
Sure, there's more. Yes.
Sam Howard from IML. So is it fair to say that you still expect to take a pizza share in Europe and Japan? And also, what are your competitors doing in terms of pricing and capacity across those markets?
Yeah, I think Josh a chance.
Yeah, Josh did come a long way. Why don't we start with Josh?
Sit down. Anyway. I'm awake now. Yeah, pizza share in Japan. We're actually. We do think some of the smaller players, the less sophisticated players, you know, probably will, you know, go away at some level. That could be, you know, further opportunity for us. But, you know, where we're really focused is just about growing the pizza category through our different pricing models and different layering in there. But yeah, we're already starting to see, if you flick back through the chart, you'll see that the smaller change is actually dropping quite a bit. But then we're sort of making up from that, and we're starting to see sort of Pizza Hut, you know, build a few more stores now as well. So whilst Pizza La, who's the other big competitor, has really done nothing, and if you look at it, it's declined from 560 to 529. It hasn't moved off that. But yeah, overall, it's going to be share and category, but mostly category, I'd say.
Yeah, it's very, very different per country. But if I look at France, and we've seen that there's lots of mom and pop stores there that either are just restaurants or restaurants with delivery. They're not really focused on the delivery, and they have some difficult choices to make in the future on do I keep delivering myself, or am I using aggregators to deliver? We see that with still, and just like Josh in Japan, I'm always envious about the data that there is in Australia about the QSR market and the pizza market and delivery. It's really fragmented and really poor data. But I have no reason to think that in France and Germany we won't see the same thing that happened in the Netherlands, that we grow the category and take share from the less sophisticated mom and pop stores.
And maybe Nick as well, given that we are more penetrated, that question in Australia, how we take share or how we build the category?
Yeah, as we keep saying, we really believe we can sell a lot more pizza here, and that when you look around the world, that's absolutely true in other cultures. And we've shown already that we've been able to grow our share of QSR from around the 2.8 mark a few years ago to where it sits today, 3.5, and that predominantly has come from growing the category through taking share from burgers, chicken sandwiches and retail. And I think we can, with the right focus, we can continue to keep doing that. I don't think that we've reached anywhere near the point of where that's not a big opportunity for us.